Hey, this is Chen here with Loancater. In this video, I'm going to go over the 8 different types of loans for small businesses. Now, every dollar your business borrows comes with a cost, and that cost is entirely determined by which type of loan you pick. There are 8 types of business loans available right now. Each one has different rates, terms, and qualifications, but most business owners only know about 2 or 3 of them, and there might be more than 8, but this is the major 8. That means the majority of business owners are overpaying on their capital every single month simply because they did not know a better option existed. So today I'm going to break down all 8 so you can walk into your next loan conversation knowing exactly what to ask for, what it should cost, and which option the person across the desk is not telling you about. Now, when someone loans your business money, a lender is making a bet that your business can generate enough cash flow to pay them back, plus their return on top. And every loan type you are about to hear comes down to 3 things. How much risk the lender thinks they are taking on, how long are they willing to wait to get paid back, and what collateral or guarantee do they have if you default. The lower the risk to the lender, the better the rates. The longer they are willing to wait, the lower your monthly payments. And the more security you can offer, the more negotiating power you have. And every loan type I'm about to walk you through is just a different combinations of these 3 variables. And once you understand that, everything else clicks into place. The first type is SBA loans. Now, I have a full video breaking down SBA loans in details, so I will link that above and in the descriptions if you want to deep dive. But here's what you need to know in order to figure out if it's the right fit for your business. The SBA does not actually lend you money. They guarantee a portion of the bank loan, so the bank takes on less risk and gives you better terms. The main program is the 7A up to 5 million, rates around 10 to 13%, terms up to 25 years if you are buying real estate. You also have the 504 for commercial real estate, with a fixed rate around 6.5% for most lenders, and the Express, which maxes out at 500,000 but moves a lot faster. Now, the catch with SBA loans is speed. You are looking at 60 to 90 days minimum on a typical deal, and that's if everything goes smoothly. So if you need capital fast, SBA is not the answer. But if you can wait, this is almost always the cheapest way to borrow. The second type is a traditional bank term loan. This is the standard loan most people picture when they think about borrowing for their business. A bank gives you a lump of sum, you pay it back in fixed monthly payments over a set period, and there's no government guarantee behind it. Rates roughly fall into the 7 to 12% category for qualified borrowers, or terms anywhere from 3 to 10 years depending on the use of funds. The advantage over the SBA is that bank term loans can move faster and there are almost no guarantee fees eating into your proceeds. But the trade-off is that banks are pickier because they are taking on 100% of the risk themselves. So they have no back sponsored by the government, and you typically need at least 2 years in business, a credit score above 680, strong cash flow, and collateral. If you have a solid banking relationship and clean financials, a conventional term loan can be a great option. If you have even one red flag on your file, a bank will pass on you faster than anyone else in this list. Now, the third type works completely differently from the first 2, and that's a business line of credit. A term loan gives you a lump sum that you pay back on a fixed schedule. A line of credit is revolving. You get approved for a maximum amount, say 250,000, and you only draw on it when you need it, and you only pay interest on what you actually use. And as long as you pay it back, the credit becomes available again. Banks' lines of credit are roughly 7 to 10% right now for well-qualified borrowers. Online lenders offer lines too, but those rates can run anywhere from 15 to 60% depending on your profile. So you want to be careful out there. This is the best product for managing cash flow variability. If you have seasonal dips, if your revenues are lumpy, if you need to cover payroll during slow months, a line of credit gives you that flexibility without locking you into a fixed monthly payments you might not need every month. But bear in mind, most lines need to be renewed annually, and the lender can reduce your limit, but choose not to renew it if your financials change. So this is operating capital, not long-term financing. The fourth type is equipment financing. This one sounds exactly like what it sounds like. A loan specifically for buying business equipment. Whether it's a truck, a CNC machine, MRI scanner, restaurant ovens, or construction equipment, the equipment itself serves as the collateral on the loan. And because the lender has a hard asset backing the deal, this is significantly easier to qualify for than most other loan types. Rates are typically 6 to 16%, and terms are usually match up to the useful life of the equipment, so anywhere from 3 to 10 years. Some lenders will finance up to 100% of the equipment cost, which means 0 down payment, and you get tax benefit on top of it. Section 179 lets you deduct the full purchase price of qualifying equipment in the year you buy it, which can offset a significant chunk of costs. If you are buying a specific piece of equipment that's going to generate revenue for your business, this is often the most straightforward path because the equipment does the heavy lifting on the collateral side. You are not tying up other credit lines. Now, if you are looking at these 4 types and trying to figure out which one fits your situation, this is exactly what we help business owners sort out every single day at Loancater. If you want us to look at your numbers and walk you through your actual options, there is a link in the description where you can fill out an application and our team will break down exactly what you qualify for, what your rates would be, and what your cheapest path to capital actually looks like. Now, these first 4 are the loan types most business owners have at least heard of. The next 4 are the ones they have not. And that is exactly where most of the money gets left on the table. The 5th type is one that a lot of business owners have never even heard of, and that is invoice factoring. If you run a B2B business and you have outstanding invoices from clients who are on net 30 or net 60 payment terms, you can sell those invoices to a factoring company at a discount and get cash within 24 to 48 hours. So instead of waiting 60 days for your client to pay you, you get 80 to 90% of the invoice value upfront. The factoring company collects from your client directly, and when your client pays, the factor sends you the remaining balance minus your fees. Those fees typically run 1 to 5% on invoice value per 30-day period. Now, the interesting thing about factoring is that the qualification is based on your customer's credit, not yours. So if your customers are large established companies that pay their bill reliably, you can qualify, even if your own credit is rough or you have been in business less than a year. But there's also a downside: costs and visibility. Your clients will know you are factoring because the factor collects from them directly, and the fees add up fast on invoices that take a long time to get paid. This works best for staffing companies, trucking, manufacturing, and government contractors where you have reliable corporate clients but long payment cycles that create cash flow gaps. Now, the 6th type is a merchant cash advance. And I need to be straight with you on this one because I've seen more businesses get hurt by MCAs than any other product on this list. An MCA is technically not a loan. It is a purchase of your future receivables. Provider gives you a lump sum, and in return, they take a fixed percentage for daily credit and debit card sales until you have paid back the full amount plus your fees. Factor rates run typically from 1.2 to 1.5, which means for every dollar they give you, you pay back $1.20 to $1.50. Now that might sound manageable until you do the math. $250,000 at a 1.35 factor rate paid over 10 months means you are paying $337,500. That is $87,500 in fees, which translates to over 60% effective APR. And if you are paying that back through daily debits from your bank account, roughly $1,700 a day, hitting your operating account every single business days. I worked at one of the largest MCA brokerages in the country before starting Loancater, and I've seen firsthand what happens when business owners stack multiple advances on top of each other. Your daily debit starts eating 30, 40, even 50% of your incoming revenue, and at that point, the math stops working no matter how good your business is. MCA exists because they are fast and easy to qualify for. You can get funded same day with a credit score as low as 500, but that speed comes at cost, and the daily debit structure put constant pressure on your cash flow, or weekly debit structure, or monthly debit structure with a short term puts constant pressure on your cash flow in a way that no other product on this list does. If you have any other option available to you, use it first. And MCA should be a bridge, not a foundation. Now, after hearing that, you see why the next 2 types on this list are so important. Because for a lot of business owners, especially the ones who own property, these are the product that gets you off expensive short-term debt entirely. And that's not to say that MCA debt is entirely bad. We personally fund a lot of those on balance sheet in situations where it makes sense. You have to really map out the math. Now, the 7th type is commercial real estate loans. A conventional commercial mortgage works a lot like a residential mortgage. The property serves as collateral. You put down 20 to 30% and you pay back over 5 to 25 years at rates that are typically sitting around 7 to 9%. But there's also a product called a DSCR loan, which stands for debt service coverage ratio. And that is one of the most powerful tools in commercial real estate lending right now. On a DSCR loan, qualification is based primarily on the property's income or projected market income, not your personal income. So if the property generates enough rental income to cover the debt payments by at least 1.25 times, you can qualify without showing W-2s or personal tax returns. Rates on DSCR loans start with 6% with 30-year fixed terms available. So on a $250,000 DSCR at 6.5%, your monthly payment is about $1,580 locked in for 30 years. Now compare that to the MCA I just showed you. That same $250,000 goes from $1,580 a month to $33,750 a month. Just like that, by picking the wrong product. For business owners who hold real estate and a lot of you do, this is where the biggest opportunities sit, which brings me to the 8th type. And if you own a home right now, you're probably sitting on one of the cheapest source of business capital available and do not even know. It is a business HELOC, a home equity line of credit used for your business. If you own a home with equity in it, you can borrow against that equity at rates starting around 8%, which is significantly cheaper than almost any other form of business financing on this list besides the SBA and the DSCR. It is revolving, so you can draw on it when you need it and only pay interest on what you use. The typical structure is a 10-year draw period followed by a 20-year repayment period. Now, I'm not going to sugarcoat the risk here. If you borrow against your home for your business and business cannot repay, your home's on the line, that is a real consideration. It is not something to take lightly. But for business owners who have built significant equity in their home and need access to low-cost capital, especially to refinance expensive short-term debt, a business HELOC is one of the most cost-effective tools available. Think about it this way. If you're carrying $300,000 in MCA debt at 1.25 or 1.35 factor rates, that is over $40,000 a month in daily debits. Replace that with a HELOC at 8% and your monthly interest drops to $2,000. That is $38,000 a month back in your operating account. For example, I had a client, Nazawa Sushi in Colorado, paying multiple cash advances, and they restructured their cash advance debt using their primary residence, their home. We gave them a $600,000 conventional note, monthly payments, 10 years, 8.5% APR at the time of closing, and that took them from paying close to $40,000-$50,000 a month in MCAs to a new flat monthly payment per month. That kind of restructuring changes everything for a business. And that is the real point of this entire video, because the question is not just which loan type should I get? The question is, what is the right combination of these products for where your business is right now? A HELOC to refinance your short-term debt, a DSC loan based on your commercial property, a SBA term loan for your expansion, a line of credit for working capital on top. That is what we call capital stack engineering at Loancater. And it's the single biggest lever I have seen for turning cash-strapped business into a cash flow positive one. We look at your full financial picture from your cash flow, existing debt, real estate assets, and we build the combination that actually makes sense for your situation. Well, I have personally funded over 300 loans. We work with 50+ institutional investors, and we have carried a 60% approval rates on all our applications. So if you want us to look at your situation, tell you exactly which of these 8 loan type fits your business, there's a link in the description below where you can fill out an application. And our team will map out exactly what you qualify for, what your rates would be, and how much you could be saving every single month compared to what you're paying right now. Thank you for watching, and I will see you guys on the next one.